Hi, we're talking about a very important tool used a lot in financial planning, and this is something called the Rule of 72. I work at home, so I think I'm going to take a little break here and close the door. But what I've done is I've got an Excel spreadsheet. Um, this is probably one of the greatest feats of Microsoft engineering. And we're looking at something called the Rule of 72. And basically, this is a mathematical formula that says if you know your interest rate of return or you know your desired years to double an investment, you know how quickly, like say I've got 10,000 now, I want it to grow in an investment in 6 years to become $20,000. How quickly can I expect that to happen? And what is my investment rate? That I might expect to get on my investment, pardon me. Living at home, I got a doggy that needs to come and sit with Daddy. That's how it is. I must sit with my Daddy. If we're looking at this, if we take the years to double times the return on the investment, which is ordinarily expressed as I, or interest. If we're looking at CDs, they pay a certain fixed investment rate. If we bought a bond, it putatively gives us a set yield for the number of years the bond operates. It's a 5-year bond. When I was a kid, these would pay 7% with the intervention of the central banks. Recently, they're paying about 2 to 4. A corporate bond yields tend to long-term average have about 4.5% returns. But if we want to double money in 6 years, we've got to make 12% per annum on that money for it to work. Now you're going to ask me, how do I know that this works? Well, I'm going to show you this probably in a later one. Right now, take it on faith, if you will, that this is a rule that actually works. And it gives us some idea, if I expect to double money in very short periods of time, I'm going to take on a lot of market risk. I'm going to expect maybe small cap nominal returns. Notice though, if we get 2% annual average interest or return, kind of a typical long-term CD rate right now, or that's the top rate we're getting on 10-year treasuries. I guess, as I speak, they're closer to 1.72% per annum. And you've got to hold it for 10 years to get that. It will take 36 years for that to double. Now, let's look at maybe a more conservative but still a viable long-term investment average. Because what I'm really dealing with as we talk about the Rule of 72 is how am I going to achieve a retirement nest egg figure? I plan a series of lectures here, and maybe I haven't planned them out well enough, but what I want to look at is how do I build an endowment fund similar to, say, what Harvard has or what Yale has, not at their level necessarily, but at a family basis level. How do I get $2-3 million saved up so that I might be able to have a pretty good retirement? Because when we're at $2 or $3 million, market studies show us that we can pull out about 4% of that money annually if we remain relatively fully invested in the stock and bond markets, in the more risky parts, if you will, of the markets. and hopefully never deplete the asset. I say hopefully because the models tend to show that 95% of the time over a 30 to 35 year period, we will not deplete it. That is, we do have a 5% risk that it'll be gone at some point in there. You know, to me, that's a relatively low risk when we look at long-term returns. And we can go back to Mesopotamia if you want to and look at markets that there have always been bond markets, there's always been equity markets of some sort, you know, that we could, the parable of the talents even tells us there were investments available a long time ago that you could have gone into. You know, but if let's just say we get 6% annual average return. We may or may not get back to this as a forecastable event. It may take the central banks waking up or understanding that continuous intervention in market activity isn't necessarily very good for long-term investors. It's great short-term. It does fabulous things for us in 3 to 4 to 5 year periods, but it's not really the magic of the market kind of gets taken away. We're going to now have the central bank decisions driving short-term returns, which can adversely impact long-term. Leave that aside, all right? I'm sorry, I like to go off on tangents and wander around. You know, but if we get a 6% annual return, as it says here in this magical which must be true because it is written down in this magical Excel spreadsheet, we could double our money every 12 years. You know, if we took $10,000, put it into a 6% vehicle at age 22, at age 34, we'd have 20,000. Again, 12 years later, age 46, we would have 40,000. Now, this is relatively appealing, but we're going to come up on retirement around age 58, or even say then the next period is age 70. We're only going to have 160 grand at age 70. Not going to be anywhere near enough for us to be able to retire. So what we then look at is how might we get there? And there's something miraculous called the S&P 500 index, which is something put together by the Standard & Poor's company, which is a market firm that sort of studies and looks at investments and the viability of investments and the qualities of companies and the qualities of management, and sells this information to various brokerage houses. But what they've compiled is a list. Now, these are only U.S. companies. You know, some of us will say, well, that's limited, it's too limited. But if we look at the markets as a whole, the U.S. stock market is one of the more stable ones. It's one of the ones that has some rules. You know, the Shanghai market, at least now, is a really shaky place. It's very much like the old days in the Wall Street in the 1700s, where they would gather under a tree and all the investors would bid up stocks. Very, very unpredictable market. Now we have requirements that you have to show what your earnings are, that you have to, you know, there's a lot more research we can do, and we can actually look a little more deeply into companies. S&P 500, who's in there? Microsoft, Apple. You know, we're going to be looking at GM, GE, Ford. A lot of the great companies in the world who happen to be headquartered in the U.S. Now, you know, we may see with inversions and everything, these people moving away, but what we've got in the S&P 500 is something very magical, where it does about 10.5% per annum on average. Now, big red flag caution there. That's an average annual return. If you look at the stock market and if you look at it daily, you may go, Bailey, you're nuts. This is crazy. There's no such thing as an average annual return. Well, if you take a longer view of it, there actually is. If you look at 50-year average returns, which for most of us is probably pretty close to, if not actually understating, our individual time during our lifetime in the stock market once we've gained some sophistication. And what we get is an average return, which would be growth and dividends of 10.52% per annum. Now, is it guaranteed that this is going to go forward? No. As we've just talked about, the intervention of central banks leaves this figure engraved out. The politicization of things like the Federal Reserve Board, we're never going to be quite sure that it's going to do this, but we have a better chance of the intelligent people and the hardworking people who work in corporations who are trying to grow their business at 7, 8, 9, 10, 11, 12% per annum. They set real targets like, let's see if we can't grow this at 6%. We've already got a 4% return on our dividend. If we can add 6% of growth, we're at 10%. And this may or may not seem greedy, but asking for 12% is greedy. When you think that Bernie Madoff can lock in and give you 12%, you might want to go downtown and find a crack house, because that's crack house territory, folks. It just isn't that steady. Oddly, these big companies, these old blue chips, because they've identified how to run their business, they've identified their niche, they know their processes, it's all in place, they've got a lot of control over how markets work relative to them, they become much more predictable than, say the startups that you might see on Shark Tank. Those things may hit. Mark Cuban may make a ton of money. The ladies may know how to put that into a great market and make it work. But for most of us, we don't have that kind of investment power. So what we're going to look for is, let's look for places where we might be able to invest in very broad market, like in mutual funds, and get a reasonable return. So assuming that the rule of 72 is correct, we want to look at, I'm trying to click on it, we want to look at how quickly will money double if we put it in. And if you can look at the formula bar up here, you'll see that I've got 72 divided by 10.52. If we move this I over to the other side, we divide 72 by I, that's going to tell us how many years it takes to double. Here it goes. It tells us 6.844 years. Let's round that up to 7. That's a little more conservative result. It's really saying, we're going to take, say, a 10% return. Let's ignore the extra 0.5%. If we get it, great. If not, we're not in horrible shape. If it dips to 9.5% total return, our model isn't going to work. And let's remember, we're dealing with a model here. We're not dealing with certainty, because you may look at 50-year holding and you've really only got 4 years of gangbuster returns in that 50-year holding, but that's what drives the annual result. So, it takes a lot of faith in your fellow humans, kind of faith in market forces. I will not tell you that socialism doesn't work. Well, actually, I will tell you that. Market capitalism is part of the reason why we have pretty good comfort here in the United States. But be that as it may, moving on, we're now looking at, let's say we've got $10,000 right now, year 2016. If we invested in the S&P 500, we might anticipate we'd have 20,000 by year 23. Let's jump ahead a little bit. 14 years later, that 10,000 might now be 80K. All right? The real power we get to is that if we can let this percolate, that money just sit there and do its own stuff, in 50 years, we would have $1.28 million starting from 10,000. And I wish I could run my video too, because all you have to do this is nothing. Just leave the money in a valid 500 fund. All right. In class, I might ask, are there any questions thus far? Again, we're looking at the rule of 72. Let me go back over this just a second. And what we're looking for is how quickly will money double? The reason we're looking at this is that we want to build an endowment fund from which we can take 3 to 4% and don't plan on taking more than that, because the models really tend to fail because of central bank intervention, because of political deals, also, lack of market freedom, it's taken away periodically, et cetera, et cetera, et cetera. We do find failure in periods, or the market itself runs amok. The market gets crazy. So I've tried to move this. You may or may not be convinced, and it's not that the S&P 500 is necessarily miraculous. We can get this in most of the broad stock market mutual funds, the growth and income funds, and the income funds available out in the world. And all right, so what I've done, this may or may not make much sense, and I'm struggling with it as I look at it, is I've looked at, here we go. Let me back this up just one second. I've got a little comments I've put on these, and here are, what I've done is I've just laid out, here's what your powers of 2 are, and it becomes apparent we've got a little typo here, that it's not 1.28 million, it's 1.24 million if I'm doing it right. Yeah, so let's correct that. We'll get rid of this new keyboard, and we will save that out to the web. Notice this is kind of cool. You can screen record and still run your the power of computers compared to what I had when I was a kid is amazing. What I've done in this row is I've labeled for you what the powers of 2 are. The row below this is how many years have we held this particular investment. So here we're looking at 7 years, 14, 21, blah, 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 all the way out to, say, 70 years. Now, some people are going to go, wait a minute, you're in the crack house, Bailey. What are you talking about? 70 years holding. Well, think about it. If, maybe as a kid gets out of college, a family might say, all right, kid, here's your start. I'm going to start off as soon as you get into a pension plan, I'm going to start you off with 10 grand. That's all I'm ever going to give you. 70 years later, at age 90, this kid might well have $10.24 million as a result of giving them 10,000. Is that right? No, something's wrong here. Yeah, no, I had it right. That's not 124, it's 128. My mistake. All right, let's delete this again, because it is 128, because that's one of the powers of 2. I got ahead of myself again, so we'll correct that. Because here's your 128. That's and those of you who do computer will notice here's your binary progression. You can see all the memory deals, right? Some of us started out with 8K processors. Those of us who are in our 70s, that's what we had for a computer. It was a big deal when Tandy came out with the 256K. A lot of floppy disks had 128K total. K, not gigabytes, not megabytes. No. K. So these are like, they would hold 10 files. So we've made tremendous growth since the 80s. This is 30 years. We've done phenomenal things. Now, we're not going to get that in our ordinary looking. All right. So as we're looking at this, here's how it looks. Here's what we would have. Now, you want to add 20 years to this, and that would give you your age. So here at age 36, having put 10,000 away, we might have 40K. When we jump up here, 57, we're nearing retirement. We might have 320K. At age 64, it correlates here, we're looking at maybe $640,000. Well, what's that going to produce in terms of income? Let's look at if 4% is withdrawn from the principal, and we designate that as big P. Kind of like what happens when you drink too much coffee. We're going to look at value at the end of the term. So once we've let 10,000 sit for 10 years, or for 7 years, it becomes 20K. When we let 10 grand sit for 42 years, we get 640K. When we let it sit for 50 years, give or take, age 70, kind of, where we may really be headed in modern retirement. You're going to work in some capacity till you're 70. Boom, here you go. You're going to get that 10K will be 128 million. And notice what happens is if we pull out 4%, we can see that most of these numbers are not going to be big enough until we get near 128K. Can you live on $51,000 total? This is even before taxes. This is total income. If you look at, say, modern nursing homes, let's say you've got to be in a skilled care facility, or maybe you're in an independent facility moving to that. You're looking at $3,000 to $4,000 a month just to live in the facility, no other expenses. So it gets up, lovely. So it gets up to where we're dealing with, that may not be adequate. When we get to $2.5 million, we're at 102K. We take 30% of this out for taxes, state, local, sales tax. We're at 70K. We're starting to get to a comfortable era, but again, we're now at age 78. It's kind of hard to accumulate that kind of money in that period of time. We're not going to work till we're 78. Realistically, that's a challenging.
It is very funny. It does involve Smith, but I think that perhaps not the thing to tell him.
That's a challenging deal that we think we're going to keep making a lot of money till we're 78. The brain and the body don't exactly agree with that all the time. So hopefully you're enjoying the panoply of voices here. Maybe I should just never work when my family's at home. But what I've done in the next stage is I've left the same years of investment. So here's our 17, 7, 14, blah, 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 all the way through 70. Again, we would add 20 to this, or 22, whatever you think your starting point would be. If you're at 32, put it in there and see what you've got. And then what I've done is I've taken the doubled money and added $20,000 every investment period. Essentially $3,000 a year, half of what a current IRA produces. Is this going to be valid for you? Hopefully it is. You've got to save at this kind of level. If you're just going to rely on 10 grand put away and you're not going to put anything more in, I think you can see from the foregoing that you're going to wind up pretty short. Yeah, at age 90, you could be flush with cash if you never pull anything out. You'd have 10.24 million. You'd have 400,000 a year coming out. Take 30% away there. Let's just say you're making 250 clear a year. Yeah, under current pricing, that's going to look fabulous. We haven't looked at inflation at all, which tends to run at 3% per annum. But we'll come back to that in a bit, or maybe in a different video. And are you going to make it? I guess I'm going to drop this out and see if people give me comments on it and help me improve it. But we can see almost immediately. Now I'm going to do something here. I'm going to highlight all of these cells. Well, let's look briefly at what we're looking at, just in case we're able to add 20 grand every 21 years or every 7 years. The real magic here is that's a very minimal addition. Minimal. Big caps, huge big caps. Really, you should try to maximize 401k contributions. You should always get at least the employer match. You should probably try to also fully fund an IRA if you can. Now, we may or may not see some smart movements in personal savings accounts where Congress maybe transitions out of fixed Social Security accounts, out of single-payer healthcare systems, and moves more to personal autonomy. That may be wishful on my part. It's kind of what I'd like to see. But the more you individually save, the better your life can be at retirement, or at least the more choices you'll have as you approach the non-earning years. And let's be blunt, for most of us, age 72 on, unless we've got a desk job or a real government sinecure kind of job, at age 72, you're just really not quite up to the challenge. I know we have sitting Supreme Court justices that are older than that, and I'm not trying to cast stones at them. I think Oliver Wendell Holmes was 92 years old and died on the bench. People are going to argue that he should have retired 20 years before, but some people would say some of his best work happened in his 80s. That there's some wisdom there. For most of us, physically, 72, kind of a cutoff. If you're still having to work when you're, having to work when you're 72, you may be in big trouble. So anyway, saving becomes the key, and I hope this model sort of helps you understand that. Notice that as we get more and more money in here, our withdrawals become much more substantial. And so what I want to do is take this kind of model where I've given myself a lot of wiggle room, and I'm going to compress these a little bit and draw it in a little tighter so that maybe we can look at all of them at once. And it helps if you know how to navigate. All right, so again, here's our doubling screen. Click in a single set, and so we've got first pattern where we just look at here's what happens if we just let 10K ride in the market. Next pattern is we're going to have 10K, and then every 7 years we're going to add 20K to that. So 20K, 20 is kilo, standard abbreviation for 1,000. When you get out here to this M, that means million. All right, not as big a deal to become a millionaire as it was when I was a child. Now it's de rigueur. If you are going to retire safely, you better have well over $1 million. My estimation for most of us is we'd be a lot better off at about 2.5 million. Current retirees would be in much better financial shape if they were in the 175 to 1.75 million to 3 million ballpark total savings. Now, you cannot sell off bits of your home. This is investment assets that you can go at, reverse mortgages may work, but I would not plan on them as a cogent method. What we're talking about is real accumulation of principal or capital that we can then use to draw down. This series of tapes will take us into a lot of different investments, and probably already going on too long, and nobody on the internet will listen to this much stuff about how to save for retirement. But notice what happens when we begin to add another 20,000. Just look at this. By age 54, 57, we've now tripled how much money we had available. Just letting this sit for 5 periods, we've now tripled it. Here we're getting almost 3 times the return at age 50, at kind of that critical of retirement age. And notice we've also hit a goal of 4.02 million. When I said current time, 2016, this is what you need to retire. You need 1.75 to 3 million to be relatively safe. 4 million, you're a substantial amount safer. You got 40 grand extra a year that's coming in. When we look at, if I could pull out 160,000 a year, I may be making it pretty easy because I take I take a fourth of this out for taxes. Maybe I take a third out. I've got 100 grand that I can live on. That's 8,000 a month. When you look at your expenses, you're probably saving money at that level. Here at 80K, if this is what you can get out annually, which would coincide with, say, age 64, age 65 retirement, take 30% of this again for taxes. Your taxes at this lower income level may not be quite that high, but it's better to be a little conservative. And you're looking at, you're going to have 56,000. So maybe, let's round it. Let's make it about 60 grand that you would have. That's 5,000 a month. Can you and your spouse make it on this? Can you and your partner make it on that? Definitely when we start getting up into, we've got 8.06 million, you're looking at having 320 grand. Here we probably want to estimate 40% taxes, even though that's high. That gives us 200,000 a year to scrape by on. That's 16 grand a month or more. Because 8 grand times 12 is 96. So we're looking at $17,000 a month. Nursing home fees can be pretty high. But we may be able to afford something a whole lot better. So let me say one more thing, and then I'm going to stop. And that is, as we're beginning, one of the things we may look at as we're doing this is, what if this were a Roth account? What if this were an after-tax account where we're sitting there pouring the money in after we've paid taxes on it? Guess what happens? The numbers down here are non-taxable. This is what you actually can put in your pocket. And if you're interested in this, this is money we could hand off to our heirs. Let's say you've got 4 children, and when you die, you've got $4.02 million. You could give each of them $1 million. That would mean they'd each have $40,000 tax-free income. which may or may not be a good thing. Some people don't do well with free money. You got to be careful with your kids. Maybe you decide, I'm going to give half of this to charity and half to my kids. You're still giving them $20,000 a year, which is 3 days at Disney. Fabulous. Anyway, that's kind of the rule of 72 in a quick nutshell, 35-minute nutshell. But I hope this was helpful to you, and look for more exciting videos.